The outlook is one where we would expect to see demand remaining robust going forwards. Maybe not staggering levels of growth, but remaining robust. And at the same time, mine and recycling supply just seems to be continuing to shrink. We could see a scenario in the future where there is a fundamental shortage of metal, and that metal isn't available to investors.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vierra, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Edward Sterck joins us today. Edward is the Director of Research for the World Platinum Investment Council, and he is here to go over his Platinum Quarterly once again and give us some insight and outlook for platinum. And we're delighted to have Edward join us once again today. It's time to saddle up and silver up for Edward Sterck. Edward, welcome back to SBTV. How are you doing?
Very good, Patrick. Thank you. I hope you're well. Thank you for having me on.
Glad to have you back on. Edward, before we get into your Platinum Quarterly report, I want to start off with a little bit of history about platinum with you. The Spaniards named the metal platina or little silver when they first encountered it in Colombia. They regarded platinum as an unwanted impurity in the silver that they were mining. Edward, now I know the horses they were riding at that time, they did not have catalytic converters or anything like that, but just for speculation, what do you think would have happened if the Spaniards had taken a liking to platinum over silver at that time?
Oh, look, I think it's a good question to ask. I mean, it really was only being found in very small amounts in Colombia back then. The Native Americans in the area did use some native nuggets of platinum that they found in rivers and streams and things, and they did fashion some items out of those nuggets through effectively through beating them into shape with hammers and other objects. But the reality is that platinum as a material for making jewelry out of, or platinum investment products, was probably, from a technological perspective, beyond the Spaniards at the time, just because the melting point of platinum is so incredibly high. To actually melt it and separate it effectively and cast platinum products was probably something that required technology from later centuries to really be able to deliver successfully. So it's a nice sort of historical footnote, but I don't think it would have ever really amounted to much until much more recently, as we saw or have seen.
Alrighty, moving forward to the 21st century, similar to silver being in a deficit, platinum likewise is also in a deficit. Edward, this deficit, is it something mining or recycling can make up, or are we going to see this deficit continue to grow?
So I think it's a combination of two things. Ultimately, we've got exceptionally robust demand. So automotive demand this year is projected to be at the highest level for 7 years. Jewelry demand, in the past, I've said flat is flat is the new up for jewelry, and that was probably optimistic. But we are actually genuinely seeing an uptick in jewelry demand this year, and that's widespread geographically. Every single region is expected to show growth this year. As a whole, up 7% globally year on year. Industrial demand only expected to be up around 1% year on year, but it's important to emphasize that industrial demand is still at really quite elevated levels and well above the last 10-year average. And that's just kind of industrial demand. The individual components of it go up and down with quite high degrees of volatility. So this year, for example, chemical demand down 48% year on year. Glass demand up something like 45% year on year. But when you look at industrial demand as a whole, that volatility kind of smooths out, and you get an approximately 3.5% CAGR over the long run. So just good, steady underlying growth currently makes up around 35% of total demand. So, a good cornerstone from that perspective. Then you've got investment demand, which this year is expected to grow pretty substantially, mainly led by a big improvement in our outlook for ETF holdings, and also facilitated by the inclusion of a new line item, which is for larger bar demand in China. So that's for bars of 500 grams and above. That's expected to grow by 40% year on year. So the overall picture for demand is extremely robust. And you contrast that with supply, where we see a lot of challenges to mine supply, which is being impacted by the low prices of palladium and rhodium. That's causing or pushing the miners, particularly in South Africa, towards restructuring efforts, trying to reduce costs. They've shed around 10,000 jobs in South Africa. That's around 6% of the workforce. And they're also trying to save money in terms of capital expenditure, so cutting back on development and growth capex. Now, both of those things over the medium to longer term ultimately are likely to lead to an erosion in mine supply. Through previous capex down cycles, we've seen around a 1.2% negative CAGR. So not significant, but it's just a gradual erosion over time. Recycling supply is also extremely challenged. We are expecting a 2% year-on-year improvement in recycling supply this year, but that comes off an exceptional low. And the overall sort of 5+ year trend is for recycling supply to continue to deteriorate. So I think, putting those two together, we end up with a deficit this year that's projected to be greater than 1 million ounces. Total demand this year, a little bit more than 8 million ounces. So you can see it's a meaningful amount of the overall demand that's got to be satisfied by material that's sourced from above ground stocks. And we see those above ground stocks depleting rapidly. So down around 25% this year, ending the year at a little over 4 months of demand. And the kind of rule of thumb in commodity markets is that any above ground stock level below around 6 months of demand is really where you'd expect to begin to see some stress come into the market.
Okay, that's a great opening. We'll touch on all of these things that you mentioned here, but I want to get back to this deficit with the miners. Um, how are they as far as exploration? Are they investing into new areas, new projects to meet the demand?
And no, they're not, frankly. I mean, there are junior companies that are running exploration campaigns, both within South Africa and, in other geographies like Australia and Brazil. And there's some really, from a geological perspective, and I'm a geologist originally, so, there are some geologically very interesting opportunities out there. The reality is that the current price environment in terms of platinum, palladium, rhodium, and also some of the base metals, just isn't conducive of making investment decisions to start developing these new operations. Remember that it's a 8-10 year or even longer time frame for taking a deposit from greenfields exploration through to full production. So it's a significant outlay, both in terms of expenditure and then the time between that expenditure and when you get your return. So you've got to have a really high degree of confidence when you're going through the FID process that in 10 years' time, the market is going to be there both in terms of demand and pricing for those commodities to make that investment decision today. For platinum, that's a pretty easy decision to make. We know we've got deficits today. Most people's projections are for deficits to continue for the foreseeable future. That's driven in part by the historical end uses for platinum, including automotive end uses in the form of going into catalytic converters. But platinum also has the benefit of the projected significant growth in the hydrogen economy coming through in the latter part of this decade and really accelerating into the 2030s. The problem is that platinum isn't produced in isolation. It's produced alongside palladium, rhodium, the other PGMs, gold, copper, nickel, chrome from polymetallic ore bodies. And so when making these investment decisions, you have to be confident that the market will be there for palladium and rhodium in particular. And they're so dependent upon automotive and catalytic converter end uses. Palladium, more than 80% of palladium is used in catalytic converters. More than 70% of rhodium demand is going into catalytic converters. And the outlook for both of those metals in 10 years' time, without the benefit of something like hydrogen in terms of a new source of end demand, is much less easy to predict. And that makes it much harder to make the investment decisions today to bring on new production.
Okay, right. That's a great point. We'll touch on the automotive component as far as platinum demand in a bit. But in your platinum quarterly report, it was noted that there are restructuring plans which may hamper production, mining production. In this restructuring, is it more internal corporate restructuring, perhaps, or is this maybe some mergers and acquisitions going on?
So the last merger we saw or acquisition really was Impala Platinum bought Royal Bafokeng last year. I think that's all we're likely to see for the time being. I mean, we don't really comment on corporate activities because these companies are typically our shareholders, so we have to be careful about predicting what they're going to do. But effectively, the restructuring that's been ongoing is all internal. So it's trying to improve productivity per employee, hence the job losses that I spoke to earlier, and the shrinking of the headcount on the mines. It's also trying to minimise expenditure where possible. So as I mentioned already, reducing capital expenditure, that non-essential capital expenditure effectively. And if we look at all-in sustaining cost curves for the 12 months to June 2024 versus the 12 months to June 2023, we can see that they have actually had some success in that. So there has been a flattening in the third and fourth quartile operations of the cost curves, and those operating costs come down. They've been helped to a degree by some weakening of the rand over the past 12 months. It has shown a bit of strength recently, but overall, year on year, it's weakened versus the US dollar. But effectively, the miners have had some success. The challenge is, how sustainable is that success? And as I alluded to in my earlier remarks, what we've seen in previous capex down cycles is that you do tend to get an ongoing erosion of output as a result of that reduced expenditure. So whilst it's fairly unlikely we're going to see wholesale cuts to supply in terms of mines being put on care and maintenance or being closed, there is a higher degree of likelihood that we will see a gradual deterioration of mine supply output.
If you're enjoying this interview with Edward Sterck and I, please consider subscribing to our YouTube channel. And did you know that at Silver Bullion, there are 6 different types of accounts to fit your needs? To find out more, go to www.silverbullion.com.sg, click on the signups tab, and choose from these 6 types of accounts. Or email me, patrick@silverbullion.com.sg, and I'll help to get you started. Okay. All right. Edward, with gold, we saw the price rise. It's having a pretty good run. Silver, it's not really doing too much. So I'm curious to know, what is the investor sentiment with platinum demand? I mean, what can you tell us about that sentiment?
So, I think price is really the elephant in the room, Patrick. The underlying fundamentals are undoubtedly very attractive. The challenge is, when you see the gold price having performed so strongly, and platinum has done nothing to reflect the underlying fundamentals. I mean, it's been range bound for the last 3+ years between roughly $900 and $1,100. That's something that's kind of created a bit of a question in the minds of investors as to why hasn't platinum reacted to the underlying deficits. And we've done a lot of work on this recently. We've got a report coming out in the near future. But to share just one of the many conclusions from that report, the analysis that we've done suggests that up until about 2010, underlying fundamentals were the key factors in establishing value for platinum in the market. In other words, the platinum price. Since around 2010, other factors have been more important, principally market-related factors. That's things like the rand-dollar exchange rate, but also sentiment factors. And you can see sentiment being reflected in futures positioning. And the question would be then, well, why have those become more important than underlying supply and demand fundamentals? And the answer is somewhat prosaic, and it's mainly related to the automotive industry. And effectively, we've seen a significant deterioration in diesel car ownership in Europe, which is historically used to be more than 50% diesel in terms of light passenger vehicles. That was precipitated by Dieselgate in 2015, which is when some of the automakers were found to be cheating the system in terms of the emissions testing. And as that accelerated the kind of transition from diesel to gasoline vehicles in Europe. Added to that, you had the rise of battery electric vehicles and market expectations that battery electric vehicle technology would become the principal technology to the detriment of internal combustion engine containing vehicles. We had people talking about global market penetration rates for battery electric vehicles in 2030 of 50 to 60%. The reality, on the other hand, has been very different. We've seen significant substitution of platinum for palladium into gasoline vehicles that's compensated for the decline of diesel light-duty passenger vehicles in Europe. And we've seen a much slower pace of growth in battery electric vehicle market share going forwards. We're now sort of talking about something more like 30% by 2030 in terms of global share of the drivetrain. So effectively, those factors that were really setting market sentiment to the negative in the expectation that a significant portion of platinum's end market was going to disappear, that being the automotive demand for platinum, which is about 40 to 45% of total demand, is proving not to be the case. In fact, as I mentioned earlier, this year we're projecting automotive demand for platinum to be the highest for 7 years. So in fact, things are looking really, really strong. As a result, we expect those market and sentiment factors to begin to fade in terms of their importance to establishing platinum value, and the underlying supply-demand fundamentals to return to being the key factors for establishing value going forwards. Because we've got this higher for longer automotive demand, we've got robust demand for jewelry, for industrial applications, and also for investment as well. And so we see this kind of potential for a pivot point and a transition in terms of how price is established, what determines value, and moving back towards those underlying fundamentals in the future.
With the automotive industry, it's pretty interesting because I recall just maybe 3 to 5 years ago, all these governments came out and they were saying by 2030, X amount of percentage of cars are going to be EV. By 2040, X amount of cars are going to be EV, meaning battery electric vehicles. But we're seeing battery electric vehicles, they're sort of plateauing, while the hybrid types of vehicles, they're they're on a good uptick.
Yeah, absolutely. So, I mean, what's really happening here is very much consumer led. So, consumers are showing, significant reluctance to adopt full battery electrification, and effectively, what's happened is you've had the first cohort of consumers have adopted full battery electrification, and they've done that with government subsidies and tax incentives, and those have since been rolled back. Quite rightly so, because the governments have taken a view that you've got to stimulate the industry to begin with. Once you get production achieving certain volumes, then you get economies of scale. The cost of battery electric vehicles come down, and so you don't need to provide the same incentives. And that's very much what's happened, particularly led by China, which is producing exceptionally good value and low cost battery electric vehicles. That's slightly been ruined by the fact that you've then had protectionism come in different geographies, so tariffs on Chinese vehicles in Europe and in North America. But as a whole, that's played out as expected. The problem is that even with more sort of lower cost battery electric vehicles now being available to consumers, they still don't want them. They've got concerns around range anxiety. They've got concerns around the availability of charging infrastructure. And added to that, a lot of the lower cost battery electric vehicles are really targeting a demographic audience that typically doesn't necessarily, particularly in urban environments in the West, doesn't have access to off-street parking, and so doesn't have access to at-home charging, the ability to charge vehicles at home. And as a result, they're reliant more on expensive public charging infrastructure. And on the calculations that we've done using data from Europe and from the UK, the cost of the public charging infrastructure is so much higher than the cost of charging at home that it actually completely eradicates the running cost advantage of a battery electric vehicle versus an ICE vehicle. And that's before you get into the hassles of having to go and find a functional public charging point and plug your vehicle in and stand around for half an hour whilst it charges. So all of these things are factoring into this consumer reluctance to adopt full battery electrification. What we're seeing, though, is that the automakers who still have to hit their fleet-wide CO2 reduction targets are unable to do that from just purely focusing on battery electric vehicles. So they've pivoted and they're focusing on selling hybrid electric vehicles. And there's a lot of different varieties of hybrid vehicles, but as a whole, that's become the fastest growing segment globally at the moment in terms of type of drivetrain. It's overtaken battery electric vehicles in terms of market share, and the growth rates are significantly above battery electric vehicles at the moment. Importantly, hybrid electric vehicles, they've still got an internal combustion engine. You still need to treat the exhaust from those engines, and so you still need PGMs and the catalytic converters, and so it's supportive of that higher for longer automotive demand outlet that we've been talking to. In addition, hybrid vehicles, because the engine's being turned on and off more frequently and they're operating typically at a lower temperature as a result, you have to compensate for that by having higher loadings of PGMs in the catalytic converter to compensate for the lower temperatures. So there's a bit of a bump. It's about 10 to 15% higher per vehicle as a result, slightly offset by generally slightly smaller engine capacities versus the pure ICE equivalent in a hybrid vehicle.
And also in your Platinum Quarterly report, it was mentioned how automotive recycling continues to be impacted by a lack of quality feedstock due to sourcing headwinds and hoarding. Could you tell us a bit about this?
Yeah, so I mean, effectively what we're seeing is just as you mentioned, there is just a shortage of quality feedstock in terms of spent catalytic converters that have come off end of life vehicles, and it's a little bit hard to really unpack exactly what's going on. There is just this overriding shortage of end of life vehicles, either because existing vehicles are being driven longer and people just aren't scrapping them. Maybe they're buying a battery electric vehicle, but still keeping their old jalopy on the driveway in case they want to do a longer journey and they've got range anxiety. It's pretty hard to unpack exactly why. All we can say is that there is this ongoing shortage of quality feedstock for recycling. It's been a theme for the last 2.5 years, if not longer, getting on for 3 years now. It doesn't seem to be going away. Our base case assumptions over the medium to longer term is that situation will solve itself. There are some regulatory headwinds in the US and China as well that are causing problems, and we expect those to solve themselves too. But it's kind of the pace of that recovery is something that one could question. So to put some numbers on it in platinum terms, as I mentioned earlier, the global demand for platinum is about 8 million ounces. Recycling supply has shrunk by about 600,000 ounces over the last 3 years. So you can see it's quite a big number. And as I said, we expect that most of that to come back in a recovery in the future. But if it doesn't, or if it takes longer to come back than expected, it can have a pretty meaningful impact on the supply-demand balances over the next few years. Our forecasts beyond what we speak to in this Platinum Quarterly are for deficits of around plus minus 400,000 ounces a year. That's including the recovery and recycling. If it doesn't come through, those deficits could be meaningfully larger.
Right. So great points there. I guess it's something for us to keep an eye on as well. Uh, China, you had mentioned China earlier, and last time we spoke a few months back, you had mentioned an interesting way how China is building up their platinum reserves. Could you update us on China and its appetite for platinum?
So China is the biggest end market for platinum globally, and for PGMs in general. And they don't really have a meaningful source of domestic mine supply. There's a tiny amount of production in China, but it's really it's so small it's almost irrelevant. They do have recycling, obviously, which can be a form of supply, but ultimately that's recycling material that you have to have in country to begin with. So the way for China to make sure that it's got some level of security in terms of PGM availability, and these are strategically important minerals in many regards because particularly platinum feeds into so many different industries, from looking on a forward-looking basis, everything from producing and using green hydrogen through to using its catalytic properties in the petrochemicals, chemicals or fertilizer industries, or even as an alloying material in turbine blades for high temperature, high pressure turbines that go into sort of military applications and things like that. So the uses and the strategic importance of the PGMs is meaningful. For China to make sure it's got security of supply, therefore, it needs to build up a domestic reserve, effectively, of PGMs. And it can do that by stimulating demand for consumers to buy platinum jewelry, or for consumers to buy platinum investment products. So effectively, those consumer holdings become that kind of domestic reserve. And we're sort of seeing that play out, really, particularly in regards to platinum investment products at the moment. Jewelry, the trend has been for declining jewelry demand. We are seeing some improvements in that coming through this year, which is encouraging, but it's too early to get too excited about it. But for platinum investment demand, this has been actually also helped very much by my colleagues in China within WPIC and the efforts they've been putting in China to develop the market there, working with our product partners to design, fabricate, market, and sell platinum product that's bespoke to the Chinese market and to the Chinese consumer. And it's been extremely successful. So investment demand in China for bars and coins, plus the larger bars that I mentioned earlier, has gone from pretty much zero in 2018 to this year. We're projecting almost 250,000 ounces of demand there. So it's meaningful growth. The momentum is extremely positive, and we ultimately expect that demand to continue to grow going forwards.
And I think, as you were mentioning here with the China's appetite, in your Platinum Quarterly, you even added a new section or a new item as far as China's demand.
Yeah, so this is for larger bars. It's. I mean, in reality, it's half kilo bars and kilo bars. Most of this product is minted, so it's that means that it's high quality, retail oriented investment product. And the way that we kind of track this, because we have to audit what our product partners are producing and selling, the audit mechanism means that we exclude any sort of quasi-institutional purchases of this sort of investment product. So it really is product that's going to a retail audience effectively, which is encouraging and to see that level of demand from domestic consumers within China. And I think probably an extension of that would be, I know last time we spoke, we talked about Shanghai Platinum Week, which was upcoming at the time. We've since had Shanghai Platinum Week. We're one of the co-organisers of that. Yeah, some of the statistics out of it this year were actually quite extraordinary. So it was a full week of events, including 2 days of the seminar itself and presentations. Those were broadcast or live streamed online within China. In total, over the 2 days, we had 772,000 people watch the live stream. A bit of double counting in that. It was about 480,000 on day one, the balance on day two, and there's probably some crossover between those numbers. But even so, almost 500,000 people on day one watching a platinum conference effectively. It obviously addressed a number of different end markets. So people aren't necessarily interested in platinum per se. They might be more interested in, petroleum refining or hydrogen or all sorts of different end uses for platinum. But it still shows how important platinum is as a strategic metal to industry within China.
And we even touched on the green hydrogen last time we spoke. Um, do you see it having an easier adoption, more so than let's say what electric vehicles are going through right now?
No, I think the if we think back about using electric vehicles as a kind of I guess an historical analog for the outlook for green hydrogen. I think if you think about green hydrogen separate or to transportation, so green hydrogen powered transportation, so fuel cell electric vehicles, the existing hydrogen market at the moment is about 90 million tons globally, and that hydrogen is 99% of that hydrogen is produced through steam methane reformation of natural gas, which is a very CO2 intensive way to produce hydrogen. So there's an immediately addressable market of 90 million tons a year. So for green hydrogen, there is that market. But the kind of parallel with electric vehicles is more in terms of fuel cell electric vehicles that can use green hydrogen as an energy carrier as an alternative to using a battery. That hydrogen goes through a fuel cell that generates electricity. That electricity is used to drive the motors that provide the locomotion to the vehicle. I think in terms of the parallels with battery electric vehicles, those fuel cell vehicles will probably follow a fairly similar trajectory. You've got to kind of have the infrastructure in place first of all. For battery electric vehicles, that was charging infrastructure. For the fuel cell electric vehicles, it's hydrogen refueling infrastructure, and that kind of puts literally or figuratively puts the horse in front of the cart, and the cart being then the demand for the vehicles comes in the wake of that. So I think for fuel cell electric vehicles, we'll probably see, similar to battery electric vehicles, a fairly slow level of uptake to begin with, and then it'll accelerate through in the 2030s. And it's probably going to be biased towards heavy duty, high capacity utilization rate vehicle roles. So more long distance, heavy duty transportation than light duty passenger vehicles.
Edward, getting back to the investor, do you perhaps see a day where platinum is being, let's just say, gobbled up by industry, and mining cannot keep up, recycling cannot keep up with resupplying? The demand is just quickly outpacing supply.
Yeah,
Where
I
the
mean,
investor, where the investor may find it very difficult to obtain physical platinum.
yeah, I mean, I think that's probably the likely scenario at the moment. There's no investment going into expanding production. Demand is robust and growing. And, okay, we've got a fairly uncertain economic outlook at the moment. I mean, that seems to have been perpetually been the case for about the last 8 years. But, so there's always a risk there might be a small knockback to demand in any given year, but fundamentally, it's still growing. And there's a high degree of price inelasticity to that demand. You can't build a Ford F-150 and sell it without platinum. Similarly, you can't run a petroleum refinery without platinum catalysts. So as a result, the outlook is one where we would expect to see demand remaining robust going forwards. Maybe not staggering levels of growth, but remaining robust. And at the same time, mine and recycling supply just seems to be continuing to shrink. So yes, we could see a scenario in the future where there is a fundamental shortage of metal, and that metal isn't available to investors. I mean, in reality, if in that scenario, you would expect the platinum price to probably rise to a point where you'd begin to attract sellers, legacy holders of platinum investment product, and maybe from the ETFs and so on as well, that could act as a source of last supply to the market. But you'd have to get into a very distressed situation probably to see that material come back in meaningful volumes.
One more question for the investor. What are the different types of ways he could invest in platinum?
So there's a lot of different ways. I mean, obviously, from a physical perspective, you could buy physical investment products, so coins, bullion bars, and so on. You can buy, sort of vaulted products, so things where you buy, you put some money in with an institution such as yourselves, and obviously that institution holds vaulted product on your behalf. You can buy into ETFs. Fairly similar sort of structure really, but obviously exchange listed typically, where those ETFs are backed by vaulted physical holdings of platinum. You can also, if you are so inclined, get involved in things like the futures market and obviously take speculative positions which are not necessarily physically backed on the price direction for platinum. And then finally, there's always the miners themselves. One can buy into the equities on the expectation that any kind of increase in PGM pricing will flow through to reflect in the underlying value of those mining equities. So there's a lot of different options to pursue in terms of platinum investment.
All right, many ways. Edward Sterck, Director of Research for the World Platinum Investment Council. I want to thank you for sharing your insights with us. And can you let the people know how they can follow you on social media and get more of your info or your research with your Platinum Quarterly recently put out?
No, thank you, Patrick. So we're on LinkedIn. We've got a corporate page there. Obviously, I have my own personal one as well. And then our website is platinuminvestment.com. All of our research is distributed on LinkedIn, and it's also available on our website for free.
All right. Edward Sterck, I want to thank you again for your insights, and I look forward to seeing your next quarterly report.
Wonderful.
That was Edward Sterck, Director of Research for the World Platinum Investment Council, sharing his views and outlook for platinum. To see more of Edward's views and work, please go to www.platinuminvestment.com. If you like this video, please do subscribe, share, and give it a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.